The Great Recession was a period of general economic decline observed in world markets during the late 2000s and early 2010s. The scale and timing of the recession varied from country to country. In terms of overall impact, the International Monetary Fund concluded that it was the worst global recession since World War II. According to the U.S. National Bureau of Economic Research, the recession, as experienced in the country, began in December 2007 and ended in June 2009, thus extending over 19 months. The Great Recession was related to the financial crisis of 2007-08 and U.S. subprime mortgage crisis of 2007-09. The Great Recession has resulted in the scarcity of valuable assets in the market economy and the collapse of the financial sector in the world economy. Terminology. There are two senses of the word recession: a less precise sense, referring broadly to a period of reduced economic activity, and the academic sense used most often in economics, which is defined operationally, referring specifically to the contraction phase of a business cycle, with 2 or more consecutive quarters of GDP contraction. Under the academic definition, the recession ended in the United States in June or July 2009. However, in the broader lay sense of the word, many people use the term to refer to the ongoing hardship. Overview. The Great Recession met the IMF criteria for being a global recession, requiring a decline in annual real world GDP per capita, only in the single calendar year 2009. Despite the fact that quarterly data is being utilized as recession definition criteria by all G20 members, representing 85% of the world GDP, the International Monetary Fund has decided, in the absence of a complete data set, not to measure global recessions according to quarterly GDP data. The seasonally adjusted PPP-weighted real GDP for the G20 zone, however, is a good indicator for the world GDP, and it was measured to have suffered a direct quarter-on-quarter decline during the 3 quarters from Q3-2008 until Q1-2009, which more accurately mark when the recession took place at the global level. According to the U.S. National Bureau of Economic Research, the recession began in December 2007 and ended in June 2009, and thus extended over 18 months. The years leading up to the crisis were characterized by an exorbitant rise in asset prices and associated boom in economic demand. Further, the U.S. shadow banking system had grown to rival the depository system, yet was not subject to the same regulatory oversight, making it vulnerable to a bank run. U.S. mortgage-backed securities, which had risks that were hard to assess, were marketed around the world, as they offered higher yields than U.S. government bonds. Many of these securities were backed by subprime mortgages, which collapsed in value when the U.S. housing bubble burst during 2006 and homeowners began to default on their mortgage payments in large numbers starting in 2007. The emergence of subprime loan losses in 2007 began the crisis and exposed other risky loans and overinflated asset prices, with loan losses mounting and the fall of Lehman Brothers on the 15th of September 2008. A major panic broke out on the interbank loan market. There was the equivalent of a bank run on the shadow banking system, resulting in many large and well-established investment and commercial banks in the United States and Europe suffering huge losses and even facing bankruptcy, resulting in massive public financial assistance. The global recession that followed resulted in a sharp drop in international trade, rising unemployment and slumping commodity prices. Several economists predicted that recovery might not appear until 2011 and that the recession would be the worst since the Great Depression of the 1930s. Economist Paul Krugman once commented on this as seemingly the beginning of a second Great Depression. Governments and central banks responded with fiscal and monetary policies to stimulate national economies and reduce financial system risks. The recession has renewed interest in Keynesian economic ideas on how to combat recessionary conditions. Economists advise that the stimulus should be withdrawn as soon as the economies recover enough to chart a path to sustainable growth. The distribution of household incomes in the United States has become more unequal during the post-2008 economic recovery, a first for the U.S. but in line with the trend over the last 10 economic recoveries since 1949. Income inequality in the United States has grown, from 2005 to 2012 in more than 2 out of 3 metropolitan areas. Median household wealth fell 35% in the U.S. from $106,591 to $68,839 between 2005 and 2011. Causes. Panel reports. The majority report of the U.S. Financial Crisis Inquiry Commission, composed of 6 Democratic and 4 Republican appointees, reported its findings in January 2011. It concluded that the crisis was avoidable and was caused by widespread failures in financial regulation, including the Federal Reserve's failure to stem the tide of toxic mortgages, dramatic breakdowns in corporate governance including too many financial firms acting recklessly and taking on too much risk, an explosive mix of excessive borrowing and risk by households and Wall Street that put the financial system on a collision course with crisis, key policymakers ill-prepared for the crisis, lacking a full understanding of the financial system they oversaw, and systemic breaches in accountability and ethics at all levels. There were 2 Republican dissenting FCIC reports. One of them, signed by 3 Republican appointees, concluded that there were multiple causes. In his separate dissent to the majority and minority opinions of the FCIC, Commissioner Peter J. Wallison of the American Enterprise Institute primarily blamed U.S. housing policy, including the actions of Fannie and Freddie, for the crisis. He wrote, "When the bubble began to deflate in mid-2007, the low-quality and high-risk loans engendered by government policies failed in unprecedented numbers." In its declaration of the Summit on Financial Markets and the World Economy, dated the 15th of November 2008, leaders of the Group of 20 cited the following causes. During a period of strong global growth, growing capital flows, and prolonged stability earlier this decade, market participants sought higher yields without an adequate appreciation of the risks and failed to exercise proper due diligence. At the same time, weak underwriting standards, unsound risk management practices, increasingly complex and opaque financial products, and consequent excessive leverage combined to create vulnerabilities in the system. Policymakers, regulators and supervisors in some advanced countries did not adequately appreciate and address the risks building up in financial markets, keep pace with financial innovation, or take into account the systemic ramifications of domestic regulatory actions. Narratives. There are several narratives attempting to place the causes of the recession into context, with overlapping elements. 4 such narratives include: there was the equivalent of a bank run on the shadow banking system, which includes investment banks and other non-depository financial entities. This system had grown to rival the depository system in scale, yet was not subject to the same regulatory safeguards. Its failure disrupted the flow of credit to consumers and corporations. The U.S. economy was being driven by a housing bubble. When it burst, private residential investment fell by nearly 4% GDP, and consumption enabled by bubble-generated housing wealth also slowed. This created a gap in annual demand of nearly $1 trillion. The U.S. government was unwilling to make up for this private sector shortfall. Record levels of household debt accumulated in the decades preceding the crisis resulted in a balance sheet recession once housing prices began falling in 2006. Consumers began paying off debt, which reduces the consumption, slowing down the economy for an extended period while debt levels are reduced. U.S. government policies encouraged home ownership even for those who could not afford it, contributing to lax lending standards, unsustainable housing price increases, and indebtedness. Underlying narratives number 1 to 3 is a hypothesis that growing income inequality and wage stagnation encouraged families to increase the household debt to maintain the desired living standard, fueling the bubble. Further, this greater share of income flowing to the top increased the political power of business interests, who used that power to deregulate or limit regulation of the shadow banking system. Trade imbalances and debt bubbles. The Economist wrote in July 2012 that the inflow of investment dollars required to fund the U.S. trade deficit was a major cause of the housing bubble and financial crisis. The trade deficit, less than 1% of GDP in the early 1990s, hit 6% in 2006. The deficit was financed by inflows of foreign savings, in particular from East Asia and the Middle East. Much of that money went into dodgy mortgages to buy overvalued houses, and the financial crisis was the result. In May 2008, NPR explained in the Peabody Award-winning program The Giant Pool of Money that a vast inflow of savings from developing nations flowed into the mortgage market, driving the U.S. housing bubble. This pool of fixed-income savings increased from around $35 trillion in 2000 to about $70 trillion by 2008. NPR explained this money came from various sources. The main headline is that all sorts of poor countries became kind of rich, making things like TVs and selling us oil. China, India, Abu Dhabi, Saudi Arabia made a lot of money and banked it. Describing the crisis in Europe, Paul Krugman wrote in February 2012 that, "What we're basically looking at then, is a balance of payments problem, in which capital flooded south after the creation of the euro, leading to overvaluation in southern Europe." Monetary policy. Another narrative about the origin has been focused on the respective parts played by the public monetary policy and by the practices of private financial institutions. In the U.S., mortgage funding was unusually decentralized, opaque, and competitive, and it is believed that competition between lenders for revenue and market share contributed to declining underwriting standards and risky lending. While Alan Greenspan's role as chairman of the Federal Reserve has been widely discussed, there is also the argument that Greenspan's actions in the years 2002 to 2004 were actually motivated by the need to take the U.S. economy out of the early 2000s recession caused by the bursting of the dot-com bubble, although by doing so he did not help avert the crisis, but only postpone it. High private debt levels. Another narrative focuses on high levels of private debt in the U.S. economy. USA household debt as a percentage of annual disposable personal income was 127% at the end of 2007, versus 77% in 1990. Faced with increasing mortgage payments as their adjustable-rate mortgage payments increased, households began to default in record numbers, rendering mortgage-backed securities worthless. High private debt levels also impact growth by making recessions deeper and the following recovery weaker. Robert Wright claims the amount of debt in the U.S. economy can be traced to economic inequality, assuming that middle-class wages remain stagnant while wealth concentrated at the top, and households pull equity from the homes and overload on debt to maintain living standards. The IMF reported in April 2012 household debt soared in the years leading up to the downturn. In advanced economies, during the 5 years preceding 2007, the ratio of household debt to income rose by an average of 39 percentage points to 138%. In Denmark, Iceland, Ireland, the Netherlands, and Norway, debt peaked at more than 200% of household income. A surge in household debt to historic highs also occurred in emerging economies such as Estonia, Hungary, Latvia, and Lithuania. The concurrent boom in both house prices and the stock market meant that household debt relative to assets held broadly stable, which masked households' growing exposure to a sharp fall in asset prices. When house prices declined, ushering in the global financial crisis, many households saw the wealth shrink relative to the debt and, with less income and more unemployment, found it harder to meet mortgage payments. By the end of 2011, real house prices had fallen from the peak by about 41% in Ireland, 29% in Iceland, 23% in Spain and the United States, and 21% in Denmark. Household defaults, underwater mortgages, foreclosures, and fire sales are now endemic to a number of economies. Household deleveraging by paying off debts or defaulting on them has begun in some countries. It has been most pronounced in the United States, where about two-thirds of the debt reduction reflects defaults. Pre-recession economic imbalances. The onset of the economic crisis took most people by surprise. A 2009 paper identifies 12 economists and commentators who, between 2000 and 2006, predicted a recession based on the collapse of the then booming housing market in the United States. Dean Baker, Wynd Godley, Fred Harrison, Michael Hudson, Eric Jansizen, Steve Keen, Jacob Brogner Madsen, Jens K. J. A. R. Sorensen, Gert Richard Barker, Nouriel Roubini, Peter Schiff, and Robert Schiller. Housing bubbles. By 2007, real estate bubbles were still underway in many parts of the world, especially in the United States, France, United Kingdom, Spain, the Netherlands, Australia, United Arab Emirates, New Zealand, Ireland, Poland, South Africa, Israel, Greece, Bulgaria, Croatia, Norway, Singapore, South Korea, Sweden, Finland, Argentina, Baltic States, India, Romania, Ukraine, and China. U.S. Federal Reserve Chairman Alan Greenspan said in mid-2005 that, at a minimum, there's a little froth. It's hard not to see that there are a lot of local bubbles. The Economist newspaper, writing at the same time, went further, saying, the worldwide rise in house prices is the biggest bubble in history. Real estate bubbles are followed by a price decrease that can result in many owners holding negative equity. Increases in uncertainty. Increases in uncertainty can depress investment or consumption. The 2007-14 recession represents the most striking episode of heightened uncertainty since 1960. Ineffective or inappropriate regulation. Regulations encouraging lax lending standards. Several analysts, such as Peter Wallison and Edward Pinto of the American Enterprise Institute, have asserted that private lenders were encouraged to relax lending standards by government affordable housing policies. They cite the Housing and Community Development Act of 1992, which initially required that 30% or more of Fannie's and Freddie's loan purchases be related to affordable housing. The legislation gave HUD the power to set future requirements, and eventually a 56% minimum was established. To fulfill the requirements, Fannie Mae and Freddie Mac established programs to purchase $5 trillion in affordable housing loans, and encouraged lenders to relax underwriting standards to produce those loans. These critics also cite, as inappropriate regulation, the National Home Ownership Strategy, Partners in the American Dream, which was compiled in 1995 by Henry Cisneros, President Clinton's HUD secretary. In 2001, the independent research company, Graham Fisher and Amp Company, stated, while the underlying initiatives of the were broad in content, the main theme was the relaxation of credit standards. The Community Reinvestment Act is also identified as one of the causes of the recession by some critics. They contend that lenders relaxed lending standards in an effort to meet CRA commitments, and they note that publicly announced CRA loan commitments were massive, totaling $4.5 trillion in the years between 1994 and 2007. However, the Financial Crisis Inquiry Commission concluded that Fannie and Amp Freddie were not a primary cause of the crisis and that CRA was not a factor in the crisis. Further, since housing bubbles appeared in multiple countries in Europe as well, the FCIC Republican minority dissenting report also concluded that U.S. housing policies were not a robust explanation for a wider global housing bubble. The view that U.S. government housing policy was a primary cause of the crisis has been widely disputed, with Paul Krugman referring to it as imaginary history. Derivatives. Author Michael Louis wrote that a type of derivative called a credit default swap enabled speculators to stack bets on the same mortgage securities. This is analogous to allowing many persons to buy insurance on the same house. Speculators that bought CDs protection were betting that significant mortgage security defaults would occur, while the sellers bet they would not. An unlimited amount could be wagered on the same housing-related securities, provided buyers and sellers of the CDs could be found. When massive defaults occurred on underlying mortgage securities, companies like AIG that were selling CDs were unable to perform their side of the obligation and defaulted. U.S. taxpayers paid over $100 billion to global financial institutions to honor AIG obligations, generating considerable outrage. Derivatives such as CDs were unregulated or barely regulated. Several sources have noted the failure of the U.S. government to supervise or even require transparency of the financial instruments known as derivatives. A 2008 investigative article in The Washington Post found that leading government officials at the time vehemently opposed any regulation of derivatives. Indiana 1998. Brooksley Eastbourne, head of the Commodity Futures Trading Commission, put forth a policy paper asking for feedback from regulators, lobbyists, legislators on the question of whether derivatives should be reported, sold through a central facility, or whether capital requirements should be required of the buyers. Greenspan, Rubin, and Lovett pressured her to withdraw the paper, and Greenspan persuaded Congress to pass a resolution preventing CFTC from regulating derivatives for another 6 months when Bourne's term of office would expire. Ultimately, it was the collapse of a specific kind of derivative, the mortgage-backed security, that triggered the economic crisis of 2008. Shadow banking system. Paul Krugman wrote in 2008 2009 that the run on the shadow banking system was the core of what happened to cause the crisis. As the shadow banking system expanded to rival or even surpass conventional banking in importance, politicians and government officials should have realized that they were recreating the kind of financial vulnerability that made the Great Depression possible, and they should have responded by extending regulations and the financial safety net to cover these new institutions. Influential figures should have proclaimed a simple rule: anything that does what a bank does, anything that has to be rescued in crises the way banks are, should be regulated like a bank. Quote. He referred to this lack of controls as malign neglect. During 2008, 3 of the largest U.S. investment banks either went bankrupt or were sold at fire sale prices to other banks. The investment banks were not subject to the more stringent regulations applied to depository banks. These failures exacerbated the instability in the global financial system. The remaining 2 investment banks, Morgan Stanley and Goldman Sachs, potentially facing failure, opted to become commercial banks, thereby subjecting themselves to more stringent regulation but receiving access to credit via the Federal Reserve. Further, American International Group had insured mortgage-backed and other securities but was not required to maintain sufficient reserves to pay its obligations when debtors defaulted on these securities. AIG was contractually required to post additional collateral with many creditors and counterparties, touching off controversy when over $100 billion of U.S. taxpayer money was paid out to major global financial institutions on behalf of AIG, while this money was legally owed to the banks by AIG. A number of congressmen and media members expressed outrage that taxpayer money was used to bail out banks. Economist Gary Gorton wrote in May 2009, "Unlike the historical banking panics of the 19th and early 20th centuries, the current banking panic is a wholesale panic, not a retail panic." In the earlier episodes, depositors ran to the banks and demanded cash in exchange for the checking accounts. Unable to meet those demands, the banking system became insolvent. The current panic involved financial firms running on other financial firms by not renewing sale and repurchase agreements or increasing the repo margin, forcing massive deleveraging, and resulting in the banking system being insolvent. The Financial Crisis Inquiry Commission reported in January 2011, in the early part of the 20th century, we erected a series of protections: the Federal Reserve as a lender of last resort, federal deposit insurance, ample regulations to provide a bulwark against the panics that had regularly plagued America's banking system in the 20th century. Yet, over the past 30-plus years, we permitted the growth of a shadow banking system, opaque and laden with short-term debt that rivaled the size of the traditional banking system. Key components of the market, for example, the multi-trillion-dollar repo lending market, off-balance sheet entities, and the use of over-the-counter derivatives, were hidden from view. Without the protections we had constructed to prevent financial meltdowns, we had a 21st-century financial system with 19th-century safeguards. Systemic crisis. The financial crisis and the recession have been described as a symptom of another, deeper crisis by a number of economists. For example, Ravi Batra argues that growing inequality of financial capitalism produces speculative bubbles that burst and result in depression and major political changes. Feminist economists Sales McKay and Margan Bjornholt argue that the financial crisis and the response to it revealed a crisis of ideas in mainstream economics and within the economics profession, and call for a reshaping of both the economy, economic theory and the economics profession. They argue that such a reshaping should include new advances within feminist economics and ecological economics that take as the starting point the socially responsible, sensible and accountable subject in creating an economy and economic theories that fully acknowledge care for each other as well as the planet.